Take a look at this chart showing total wealth accumulated in American retirement accounts. The line climbs steadily for decades, eventually compounding to a staggering $10 trillion. Today, roughly 70 million Americans rely on this exact system to fund their later years. The architect behind that massive ecosystem is Ted Benna, but at 84 years old, as he looks back at the wealth his invention generated, he feels a deep sense of regret. The issue comes down to how the mechanism actually works. The modern 401k relies on voluntary paycheck deductions. If you have plenty of disposable income, siphoning off a percentage every 2 weeks is an easy way to build a nest egg. But if you are stretching your paycheck just to afford weekly groceries, opting into a pay cut is mathematically impossible. That structural flaw has locked entire demographics out of the system. Millions of hourly wage earners, retail staff, and warehouse workers simply cannot afford to participate, even when their companies offer a plan. Staring down 85 from his farm in rural Pennsylvania, Benna has come to a difficult realization. His life's work essentially amounts to a highly effective tax strategy for the wealthy. Now he wants to fix the very system he built. The financial innovation that minted thousands of millionaires simultaneously left the working class behind. The question is whether Benna has enough time left to engineer a new framework that actually works for everyone else. To understand the fix, you have to understand the original hack. Back in the late 1970s, the baseline expectation for retirement was entirely different. Benna was working as a benefits consultant, helping doctors and lawyers maximize their tax breaks. One Saturday afternoon in 1981, he was reading through a recent addition to the tax code, specifically a provision from 1978 governing executive profit sharing. He realized the text could be interpreted in a completely new way. His idea allowed rank-and-file staff to defer a portion of their own paychecks, before taxes, directly into a company profit-sharing plan. Because of where the provisions sat in the tax code, this bare-bones setup became known as a Section 401k. The IRS approved the concept, and Benna started pitching it to clients. Corporations quickly caught on to a massive secondary benefit. Instead of funding expensive traditional pensions out of their own pockets, they could offer this new self-directed savings plan and wipe pension liabilities off their balance sheets entirely. By the late 90s, workers on these defined contribution plans eclipsed those with guaranteed pensions. The entire burden of retirement risk, and the math required to get there, was transferred directly from the employer's ledger to the employee's shoulders. The 401k was never designed to replace the pension system. By allowing it to do exactly that, the financial industry created a vacuum where saving for the future became a luxury rather than a standard benefit of employment. Benna's proposed solution is a completely new project called Radish. It is a savings plan engineered specifically for employees earning less than $160,000 a year. The crucial difference lies in the underlying framework. Radish is built on a 401a, a plan type that has existed since the 50s. Under this structure, the employer directly funds the account. The worker faces zero paycheck deductions. This flowchart illustrates exactly how the money moves. Instead of a guaranteed match, the employer's contribution is tied to daily performance goals. When a worker maintains a perfect safety record, hits an on-time delivery metric, or reaches a tenure milestone, it triggers a direct deposit from the company straight into the employee's savings bucket. Because these contributions never pass through standard payroll, the employer legally avoids paying payroll taxes on the rewards. Simultaneously, that money sits in a tax-advantaged account for the employee, where it can compound and grow tax-free until withdrawal. Workers track their growing funds through a digital app, watching their radishes accumulate in real time. The goal is to use behavioral psychology to help them build a savings habit, showing them exactly what those daily $5 rewards will add up to by the end of the year. By shifting the core funding mechanism away from an income sacrifice and turning it into a performance reward, Radish removes the exact point of friction that broke the retirement system for lower-income workers. Getting the idea on paper was the easy part. The real-world friction comes from the employers themselves. Corporate HR departments suffer from a herd instinct. If they want to incentivize workers, they default to offering simple cash bonuses, rather than navigating the setup of a new tax-advantaged reward plan. There is also structural criticism from economists. Social Security benefits are calculated based on a worker's 35 highest earning years. Because Radish rewards bypass traditional payroll, they don't count as cash compensation, which lowers a worker's lifetime taxable earnings and could slightly decrease their future government benefits. Bennett counters that argument with a simple reality check. If an employee is struggling to afford rent today, establishing an immediate financial safety net is vastly more useful to them than a slightly larger Social Security check 30 years down the line. Despite the hurdles, there are early signs of traction. A pilot program is currently rolling out for roughly 200 workers in the trucking industry. High driver turnover is a massive, costly expense for fleet operators, and these visible, app-tracked savings incentives are being tested as a way to keep drivers in their seats. Benna knows how corporate inertia works, and he acknowledges his own timeline. When he first pitched the 401k, people told him it was illegal and would never work. He expects the same slow grind for Radish, admitting he probably won't be alive to see if this new plan actually takes off. In 1981, he accidentally planted a seed in the tax code that dismantled the working-class pension. Now, in the twilight of his career, he is planting one last seed, hoping it will finally give those same workers a chance to grow their wealth back.